Chinese car company XPENG has had a wild few years. Despite delivering over 400,000 vehicles, the stock has fallen 87% from its 2021 peak. At the latest price, XPENG now has a market cap just under $7.3 billion, with $5.7 billion of cash and investments on its balance sheet and $1.6 billion of long-term debt. The enterprise value is $3.1 billion. Revenue over the last 12 months comes to $4.6 billion, but net income, adjusted ebitda and free cash flow are all negative, as the company has yet to reach profitability. The problem facing XPeng is the same for many other EV companies around the world: a slowdown in consumer demand for electric vehicles and a vicious price war. Industry leaders BYD and Tesla have continued to cut prices, putting pressure on smaller players, which has caused many companies to go under. Chinese car makers Li Auto, Nio and Xpeng are all facing the same pressures to keep prices low. The problem for Xpeng is that even with gross margins improving to nearly 13% in the first quarter, there simply isn't enough room to compete on price and still turn a profit. The company remains a long way from break even, with adjusted EBITDA margins likely to be about negative 13% next year, according to analyst estimates. The company needs more scale to close that gap. Meanwhile, the US and Europe continue to penalize Chinese car makers with large import tariffs. So XPeng still has a lot of work to do and a lot more cars to sell if it's to reach profitability. Even so, XPeng does have some positive attributes. The cars themselves are innovative, affordable and well reviewed, with full self-driving capabilities to come next year. Vehicle sales at XPeng are increasing rapidly and prices are still lower than most even after tariffs have been applied. XPeng also secured a $700 million partnership with Volkswagen that should provide the company with recurring revenue from software licensing plus help in the development of 2 new models. That partnership valued XPeng at $14 billion, almost double the current market cap. And just a few days ago, the company announced its new Mona brand, which seeks to challenge the budget segment of the market with a car under 20k. Crucially, with $5.7 billion of liquidity, XPeng has no near-term bankruptcy risk and plenty of time to gain market share. Put it all together and there's a sense that XPeng is a feast or famine type stock. Any company that is a major part of the Chinese or global EV market will have a market capitalization much greater than $7 billion, and there's a sense that China will dominate this industry even with international tariffs. Competition, however, is the key issue, with BYD selling more than 20 times as many vehicles as XPeng while managing gross margins over 20%. So XPeng has to prove it can truly compete with BYD and Tesla before its stock can put in a serious rally. But these are my personal opinions, not financial advice, and I hold no position in XPeng stock. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.